A man walks into a bank in 1923 Germany and deposits enough money to buy a house. 18 months later, that same pile of money can't even buy him a loaf of bread. The house is gone. The bread is gone. The only thing left is a stack of paper that used to mean something. This is not a horror story from the past. This is a warning that rich people have memorized and everyone else has forgotten. Because here's the truth nobody tells you: the wealthiest people on earth treat a savings account the way you treat a car somewhere to park. Somewhere to leave something for a very short time, never a place to build a life. And once you understand why, you'll never look at your own bank balance the same way again. Let's talk about why the rich never let their money sleep. Most of us grew up believing the same thing: work hard, save your money, put it in the bank, watch it grow. It sounds comfortable. It sounds safe. It sounds like the version of adulthood our parents promised us. But somewhere between your grandparents' generation and today, that advice quietly stopped working. Nobody warned them. Nobody cancelled the old rules. The world just changed underneath them, and the people who noticed first, the bankers, the investors, the billionaires, they adjusted, quietly, while the rest of us kept doing what we were told. By the end of this video, you'll understand exactly what they figured out. You'll see why $1 sitting in your bank account is actually losing a race every single day, even while the number on the screen stays the same. And you'll learn what the wealthy do instead, not tomorrow, not someday, but right now, with every dollar that touches their hands. But first, you need to understand one mysterious thing that's been robbing you since the day you opened your first bank account. Part 1. The Silent Thief. Here's a question. If you put $100 in the bank today and it's still $100 in 10 years, did you break even? I believe that most of you say yes. The number didn't change, so nothing was lost. But that's the trick. That's the illusion that keeps millions of people financially stuck their entire lives. Because $100 today buys groceries, gas, a nice dinner. $100 10 years from now buys less of all three. Prices creep up almost every year. Economists have a boring name for it: inflation. They use this name to draw people into their own illusions. Think of it like a leaky bucket. You pour water in, and it looks full. But there's a tiny hole at the bottom that you can't see. Slowly, quietly, the water level drops, even though you never touch the bucket. Banks do offer interest, a small reward for leaving your money with them. But here's the part they don't put on billboards: that interest almost never outruns the leak. Historically, savings accounts pay out a small percentage each year, while prices climb by roughly the same amount or more. You're not gaining. You're treading water while the pool slowly drains. And the wealthy know something most people don't. Money that isn't growing faster than prices are rising isn't actually safe. It's shrinking in slow motion. Which raises an uncomfortable question. If keeping money in the bank isn't safety, then what has safety actually meant this whole time? To answer that, we need to go back to a decision 3 friends made, and why only one of them ended up wealthy. Part 2. The Parable of 3 Friends. Picture 3 friends who each inherit $10,000. The first friend does exactly what most people were taught. He puts it in a savings account and feels proud every time he checks the balance. Safe and comfortable way. The second friend is nervous about losing money, so he keeps it in cash, tucked away at home. At least nobody can take it in a bank collapse, he tells himself. The third friend does something that makes the other 2 nervous. He buys a small stake in a handful of businesses, companies that make things people need every single day, in good times and bad. 10 years pass. The first friend's money has technically grown a little, but prices have grown also. He can buy less than he could a decade ago. He doesn't realize it because the number on the screen went up, but his purchasing power quietly went down. The second friend is in the worst position of all. His cash never grew a cent. It just sat there, aging, losing value every single year like fruit left out on the counter. The third friend's investment has been through storms, dips that made his stomach turn, months where the value dropped and he wanted to sell everything. But those businesses kept doing what businesses do. They sold products, made profits, grew a little more valuable year after year. His original 10,000 has multiplied several times over. Same starting point, same 10 years, but different results. This is not luck. This is the difference between owning something that grows and lending your money to something that barely keeps pace with inflation or doesn't move at all. But here's where it gets interesting. Why did the third friend win, even after living through the same crashes and panics as everyone else? The answer lies in something the wealthy understand about time that most people never learn until it's too late. Part 3. The Secret Language of Time. There's a story about a king who wanted to reward a wise man for solving a difficult puzzle. The wise man asked for something that sounded almost like an insult. Just 1 grain of rice on the first square of a chessboard, then double it on each square after that. The king laughed and agreed instantly. By the 20th square, the rice pile was already impressive. But by the 64th square, the total amount of rice was larger than anything the kingdom had ever produced. Enough to bury the entire palace. That's the magic power of compounding. It starts slow, almost difficult to notice, and then it explodes. Money that sits in a bank barely doubles across an entire human lifetime. Money that's invested in growing businesses can double, then double again, because each cycle of growth builds on the last one. This is why wealthy families obsess over starting early instead of starting big. A modest amount invested at 25 can outgrow a much larger amount invested at 45, purely because time had more chances to multiply it. The rich aren't smarter about money, they're just more patient with growth and less patient with money that isn't working. Which brings us to the real reason banks exist in the first place, and it's not the reason most people assume. Part 4. Who is the bank really working for? Here's the truth that most people don't know. When you deposit money in a bank, you're not just storing it, you're lending it to them. The bank takes your money and loans it out to other people, often at rates far higher than what they pay you. That's the entire business model. You lend them your money cheaply. They lend it out expensively. The difference is their profit. You're essentially the least important part of a very profitable machine. The wealthy figured this out generations ago, so instead of playing the role of the lender getting a tiny return, they positioned themselves on the other side. They became the owners, the ones collecting the bigger returns, not the small ones. This is why billionaires don't brag about their savings account balance. Nobody's ever heard a wealthy person say, "I feel so secure for putting money on bank account." Instead, they talk about ownership, shares in companies, pieces of real estate that generate income, stakes in businesses that produce something valuable year after year. Owning a small piece of something that grows will always outperform lending your money to someone else for a tiny fee. But this raises the obvious question. If investing is so powerful, why doesn't everyone do it? The answer isn't math, it's psychology, and it explains why so many people stay stuck even when they know better. Part 5. The fear that keeps people. Poor losing money feels far worse than gaining the same amount feels good. This isn't a personality flaw. It's wired into the human brain. Psychologists call it loss aversion, and it explains almost every bad financial decision people make. When your investment drops 5%, your stomach drops with it. When it dips 10%, panic sets in, even if history shows it will likely recover. That gut-level fear convinces people to pull their money out at exactly the wrong moment, lock in the loss, and retreat to the safety of a bank account. Meanwhile, that same account is losing value every single year to inflation, just slowly enough that it doesn't trigger the same fear response. Slow loss feels safer than fast loss, even when slow loss is actually more dangerous over time. The wealthy aren't immune to this fear. They feel it too, but they've trained themselves to recognize it for what it is: an ancient survival instinct completely unsuited for modern financial decisions. Your brain evolved to fear a lion in the grass, not a market correction on a screen. So they zoom out. They ignore the daily panic. They focus on decades, not days. And that shift in thinking, from reacting to every dip to trusting long-term growth, is the exact moment someone stops behaving like an employee of their money and starts behaving like its owner. So here's what separates the wealthy from everyone else. It was never about how much money they started with. It was about where they chose to put it and how long they were willing to let it grow. A bank account protects your money from thieves, but it can't protect your money from time. Only ownership and patience does that. The next time you look at your bank balance and feel a sense of comfort, ask yourself an honest question. Is that number actually working for you, or is it simply resting while the world moves on without it? Because somewhere out there, right now, someone with far less money than you is quietly getting richer, simply because they refuse to let their money sleep.